Before you invest in the next billion-dollar startup, you need to understand one dangerous reality about modern business. Not every failed company was truly a failure. Some collapses are engineered. Some disasters are profitable. And some founders walk away richer after the destruction than they were during the success. Welcome to Wealth Logic Pro. Today we are breaking down the art of the exit scam, the hidden logic behind failed startups, collapsed crypto projects, fake growth companies, and financial illusions designed to extract money before disappearing. This is not fiction. This is a pattern repeated across tech, finance, crypto, e-commerce, and even artificial intelligence companies. And if you understand the psychology behind it, you will never look at startup culture the same way again. Modern startup illusion. The public believes startups are built on innovation, but many are actually built on perception. In the modern financial world, valuation matters more than profitability. A company can lose millions every month and still be considered successful if investors believe future growth is coming. This creates a dangerous incentive structure. Founders no longer need to build sustainable businesses. They only need to build excitement long enough to attract capital. Think about it carefully. If a startup raises $50 million, pays its executives massive salaries, signs consulting deals, sells secondary shares privately, and then collapses 2 years later, was it truly a failure? For investors, yes. For the founders? Not always. This is where the concept of the exit scam begins. An exit scam does not always mean someone disappears overnight with a suitcase full of money. Modern exit scams are more sophisticated. They hide behind legal structures, media narratives, and financial engineering. The company burns cash aggressively. Growth metrics are exaggerated. Public hype increases. Investors pour in more money. Executives cash out strategically. Then the collapse happens. And suddenly everyone says, the market conditions changed. The timing was unfortunate. The business model failed. But sometimes the business was never designed to survive in the first place. How hype creates billions. The most powerful asset in modern finance is not technology. It is attention. Attention creates valuation. Valuation attracts investors. Investors create credibility. Credibility creates media coverage. Media coverage attracts retail money. This cycle becomes self-reinforcing. Look at how many startups today operate. No profits, and sustainable revenue, and long-term infrastructure, but massive marketing budgets and celebrity partnerships. Because in speculative markets, perception is temporarily more valuable than fundamentals. The founder becomes the product. Luxury lifestyles are displayed online, podcasts begin appearing, magazine interviews are released, social media followers explode. The founder starts talking about changing the world. And investors become emotionally attached to the vision instead of logically analyzing the numbers. This is where irrational capital enters the system. People stop asking, how does this company make money? Instead they ask, how fast can I get in before it becomes huge? That mindset creates bubbles. And bubbles are the perfect environment for strategic exits. The psychology of greed. Exit scams do not survive because scammers are intelligent. They survive because greed disables critical thinking. When people believe they're close to wealth, they stop questioning obvious red flags. This is why failed startups often use the same psychological triggers: urgency, exclusivity, fear of missing out, luxury signaling, authority figures, fake scarcity. The goal is simple: create emotional investment before financial logic appears. This happens in crypto constantly. A project launches with promises of revolutionizing finance. Influencers promote it aggressively. Early investors show fake profits online. Communities become emotionally loyal. Then one day, liquidity disappears, developers vanish, the token collapses, and millions disappear with it. But this behavior is not limited to crypto. Traditional startups do similar things through inflated user numbers, manipulated growth metrics, artificial partnerships, and unsustainable expansion. Sometimes companies spend investor money simply to appear larger than they really are. Beautiful offices, expensive conferences, massive launch events, aggressive hiring. It creates the illusion of inevitability. People think, if they're spending this much, they must be successful. But sometimes the spending itself is the scam, the business model of failure. Now here is the uncomfortable truth most people never discuss. In some industries, failure is monetized. A founder can fail publicly and still become wealthy privately.
Here's how.
Step 1. Raise large investment rounds. Step 2. Pay yourself executive compensation. Step 3. Sell partial equity during private valuation increases. Step 4. Build public reputation as an innovative entrepreneur. Step 5. Allow the company to collapse under debt or unsustainable economics. Then repeat the cycle with a new startup. This happens more than most people realize, because venture capital operates differently than traditional businesses. VC firms expect many startups to fail. They only need a few massive winners to compensate for losses. That means investors often tolerate irrational behavior longer than normal markets would allow. And during that time, founders can extract enormous personal value. Some gain fame, some gain connections, some gain political influence, some gain future investment opportunities. Failure itself becomes part of the branding. Notice how many failed founders reappear months later, launching new companies, writing books, giving interviews, or raising even more money. In many cases, reputation survives longer than results. The media machine. The media plays a major role in startup mythology. Financial journalism often rewards exciting narratives over boring truths. 20-year-old founder disrupts industry. Startup reaches billion-dollar valuation. New app changing the future of banking. These headlines generate clicks. But few reporters deeply investigate financial sustainability until after collapse occurs.
Why?
Because optimism sells better than caution. And startups understand this. They strategically leak funding rounds. They exaggerate projections. They use technical language to confuse audiences. They hire PR teams before profitability exists. The objective is not necessarily to build value immediately. The objective is to maintain belief. Because as long as belief exists, capital continues flowing. This is the same logic that drives financial bubbles throughout history. The dot-com bubble, the housing bubble, crypto mania, speculative AI valuations. Human psychology never changes. Only the technology changes. How to protect yourself. So, how do intelligent investors avoid becoming victims? First, ignore hype and study cash flow. Real businesses generate sustainable revenue. Second, question companies that prioritize branding over fundamentals. If a startup spends more energy appearing successful than becoming profitable, that is a warning sign. Third, study incentives. Ask yourself, who benefits if this company fails tomorrow? If executives already secured wealth while investors hold all the risk, the structure may already be dangerous. Fourth, avoid emotional investing. The moment you feel urgency or fear of missing out, slow down. Financial decisions made emotionally usually end badly. And finally, understand that complexity is often used as camouflage. If nobody can clearly explain how the business makes money, do not trust it. Sophisticated language can hide weak economics. In conclusion, the art of the exit scam is not always theft in the traditional sense. Sometimes it is simply the monetization of belief. A company creates a story, the public buys the story, investors fund the story, executives profit from the story. Then eventually reality arrives. And by then the money has already moved. This is why financial intelligence matters more than ever in modern markets. Because in a world driven by hype, perception, and digital influence, the greatest asset is not capital. It is clarity. If you enjoyed this breakdown, subscribe to Wealth Logic Pro for more deep dives into finance, banking, investing psychology, wealth systems, and the hidden mechanics behind modern money. And remember, in financial markets, what looks successful is not always profitable, and what collapses publicly may have already succeeded privately.